relevance. Relevance. How relevant is this concept? How relevant is the concept of time value of money? The ball is in your court once again. Investment decisions. Someone said investment decisions. Investment decisions. Investment decisions. Investment decisions or capital budgeting decisions. When evaluating investment opportunities, candidates, the time value of money allows us to compare the value of future cash flows generated by an investment to the initial cost. And that is done through techniques like discounting, which in this lesson we are going to look at that. In this lesson, we'll move into discounting techniques. We'll be seeing how that plays out in real life. So capital budgeting is one area, or investment, all right? When evaluating investment opportunities, the time value of money allows us to compare the value of money. That is comparing one project, do you understand, with the initial cost, so that you can find out if the project is viable or not. Investing decisions. What other point we have? 2, capital budgeting. Capital budgeting. Businesses use the time value of money to assess the profitability of long-term projects, and by discounting the future cash flows back to their present value, they can make informed decisions about which projects to undertake. Capital budgeting. This concept is also applied in financing decisions. Financing decisions. Whether choosing between debt or equity financing, or evaluating different loan options, understanding the time value of money is essential because it helps in assessing the true cost of borrowing and also comparing different financing alternatives. Relevance. Valuation. Valuation. Determining the fair value of businesses or assets, determining the value of bonds, determining the value of stocks. This concept is relevant in doing that. All right? It allows for a more accurate assessment of what an entity is truly worth. It could be the whole entity, or it could be the value of assets like the financial instruments, and so on. Valuation of bonds, valuation of equities, valuation of businesses. Do you understand? Valuation. This concept is also relevant in personal finance. Personal finance. Personal finance. Now, the time value of money is also crucial for individuals, because understanding this concept helps in planning for retirement. It may also help in making individual investment decisions, okay, savings decisions, and even just evaluating the terms of things like a mortgage and so on. Personal finance is one area in which time value of money is also relevant. And you can see, candidate, these are just some of the topics that we'll be covering. This is a topic on financing, capital budgeting, valuation, personal finance. That's why this topic is very key in understanding the other topics. This is the bedrock of finance, candidates. It's like the foundation upon which most of the other topics are laid. So when you hear candidates complaining that an exam was tough, it was difficult, one of the major reasons is failure to properly grasp the concept of value of money and knowing how to discount cash flows, to compound cash flows, to compound annuities, to discount annuities, and so on. So if you've been having challenges in this paper, one area in which you need to revisit is the time value of money. And that is what we are doing now. Do you understand? So the time value of money, candidates, I repeat, recognizes that a shilling today is worth more than a shilling in future due to its earning potential. And the principle underlie many financial calculations and decisions, which makes it the cornerstone of a sound financial management.